As Prem said, Southeastern Asset Management is a long-term, concentrated, engaged value investor. And we believe it's imperative to get economic incentives properly aligned, to compound capital most productively with the least risk. Co-ownership eliminates conflicting interests and best achieves return objectives. The concept of investing in partnership with our clients and our investees' managements is important to us. Between our two private foundations, our retirement plan, and our associates' capital, we are Southeastern's largest client. We're the largest shareholder group in the long-leaf funds, and if you work for our company, you have to have all your equity savings in the long-leaf funds. And that does two things. It focuses people's attention, and it secondly prevents conflicts of interest from occurring. Two things that are very important. So we're not playing academic games with it. We have knockdown, drag-out discussions when someone says we need to buy this company, because we have 9 other people in that discussion that are saying, well, you're getting ready to make me put most of my savings into this next marginal investment. So the attention is clearly laser beamed on that next potential company that we might buy. Long-term. Being a long-term investor has distinct advantages. It reduces the number of decisions one must make. It allows you to focus on high probability investment outcomes. It minimizes frictional or transactional cost. And it defers or eliminates tax liabilities, leaving that capital to compound for you. Additionally, being a long-term investor puts you in the tiny minority of market participants where there's less competition, where you can concentrate on companies that will deliver much more free cash flow per share in 3 years, while others are trying to guess next quarter's EPS. Over our 43 years of operations at Southeastern, we've held our investments an average of 5 years. Concentrated. Since Southeastern was founded in 1975, our portfolios have owned 10 to 20 investments, depending on diversification mandates. And we've always believed a prospective new investment commitment had to be materially and demonstrably superior to our least qualified holding in order to supplant it. Adding a marginal name to a defined limit of portfolio holdings pushes you into the world of, quote, diversification. We've practiced Warren Buffett's admonition, don't put too many eggs in your basket and pick them carefully, and agree with his declaration that, quote, diversification is protection against ignorance, but if you don't feel ignorant, the need for it goes down substantially or dramatically. John Maynard Keynes, who had a spectacular investment record managing several insurance company portfolios and the King's College Foundation, addressed concentrated investing writing. To suppose that safety first consists in having a small gamble in a large number of different directions, as compared with a substantial stake in a company where one's information is adequate, strikes me as a travesty of investment policy. But to be a successful, concentrated, risk-averse investor, you must think independently, do your own appraisals, exercise incredible patience and discipline, be willing to hold cash, and then be courageous enough to go all in when you find a true investment qualifier. Most often it's when almost no one agrees with you. And you must be unafraid to look stupid in the short run. Engaged. We believe it's incredibly important to be engaged with our company's managements, not only to support them when it's warranted, but to help them make intelligent capital allocation decisions. Wise deployment of a company's cash is a paramount necessity to achieving an acceptably profitable long-term investment return. Graham talks about all good investments or all great investments have to qualify quantitatively, as we say in our shop, P to V, price to value. And secondly, qualitatively. The qualitative aspects pertain to the competitiveness of the business and the quality of your partner. And on the business side, you want those competitive advantages. You want to ensure that you're going to get stronger through time, not weaker, and whatnot. On the management side, you want two major attributes. You want a partner that can run the company and create free cash flow, and you want a partner that will reinvest that free cash generation very intelligently. So that's a rare bird. And were you lucky enough to run a company, you want to be able to grow sales, keep costs down, increase margins, be very, very careful not to overspend on capex and not to let working capital eat you up, and you would also want to be pretty good about reinvesting. Value investor. In 1997, Barron's Magazine summarized our value investing approach in their lead article entitled Business, People, Price. Said differently and more in Ben Graham's vernacular, we believe every investment must qualify quantitatively and qualitatively. A quantitative appraisal is a mathematical conclusion based on qualitative factors because every cash production and reinvestment assumption in a discounted free cash flow model is entirely dependent on the quality of the business and the quality of the people that produce the free cash flow and reinvest it. It is why the appraiser's job is to try to get the value quote approximately right instead of precisely wrong. It is why you need a large margin of safety of value over price in case you are wrong. It is why the qualitative characteristics are more important over time than your going in P to V or price to value. Qualitatively, as we've discussed, the people must be accountable, good capital allocators. They also must possess the operating skills needed to produce a growing stream of cash, and needless to say, be most ethical, shareholder-oriented, partner-like owner-operators. To amplify earlier comments, the best form of management and shareholder partnership alignment is where the CEO works for free and owns a lot. We completely agree with what Arthur Rock, the most renowned and respected venture capitalist, said when handicapping a new venture's prospects. And I quote, "Great people make great companies." Will Thorndike's The Outsiders chronicles 8 great CEO corporate value compounders and their constant, disciplined, independent, and intelligent decision-making who were always focused on prudently building their businesses' intrinsic value per share. Southeastern was fortunate to be a co-shareholder with 7 of these 8. The Outsiders is third best investment book we've read, exceeded only by The Intelligent Investor and Security Analysis. And we commend it to all of you if you haven't had a chance to read it. The qualities of these CEOs and the returns they delivered make it clear how important partnering with top-drawer, competent corporate stewards is. Qualitatively, the business must be competitively advantaged if you expect it to earn high returns on capital and to grow its value above your discount rate. An inferior company with the best CEO in North America, even purchased cheaply, is unlikely to outperform for any extended period of time. It's why time is the friend of the good business and the enemy of the bad. The good business will produce more free cash flow than its cost of capital and accrue and grow its value. The bad business will not earn its cost of capital and thus will be slowly liquidating. So if you buy a bad business materially below its liquidation value, you better be prepared to get that value quickly because it will be lower in the future. Bruce Greenwald, of course, wrote the text that you're using, Value Investing from Graham Buffett and Beyond. And Bruce outlines three things that you need to be very successful as an investor. And the first is, and I'm sure you've already talked a little bit about this, the first is a great search strategy. The second is the ability to value the business. And the third is discipline. Discipline only to buy the security if it's less than, in our case, 60 cents on the dollar. And fourthly, you need patience. Well, 3 and 4 go together. Discipline to, not to pay more than a specific price to value, and then to be patient until they evolve. So in our search strategy, we had 5 different computer screens that we ran against the CompuStat database at the time, and we had to, outsource that to others. You didn't have a PC sitting on your desk and you could do them. You had to, get hooked up with a mainframe, and it was an Amdahl or an IBM, and you ran them against this big thing in some university that had paid for the CompuStat data, which was pretty dated too. It didn't get it in a millisecond like you do today. I mean, it was maybe 2-3 quarters old, some of it annuals data, not quarterly. But we ran a screen that said, okay, computer, give us companies that have an ROC, return on capital, total capital of 12% or more, and sell for less than 8 times. Our second screen was what we called our low price to free cash generation. So, computer, give us all companies that sell below 10 times free cash flow. Free cash flow defined as net income, depreciation, depletion, amortization, deferred taxes, minus the average of the last 3 years' CapEx and working capital charges. The third screen was classic Ben Graham net screen. Give us every company out there sells below net working capital and all long-term debt and all long-term preferred. Then we had another screen where companies might be very asset intensive on the property, plant, and equipment, the fixed asset category. We said, computer, give us everything that's below net plus 20% of PP&E. And then finally, we had a screen that said, give us every company below book after you've taken out intangibles, so that you really, wanted only stuff below hard book. So we did that. We don't do that much anymore because at some point in the last 35 years, we valued most businesses we're capable of understanding, and it doesn't take us too long to update them thanks to computers. The next part of our screening process, we look at every company on the new low list. And that goes on every day by all 9 of our CFA/investment analysts that are my partners. We look at every value line that comes in, and we scan the value line data. And we scan it just as I mentioned before, thinking quantitatively and qualitatively. Maybe the right brain is your quantitative eye, and the left brain is your qualitative eye. And so as you're going through that value line page, you're looking, is this cheap to free cash flow? Is this cheap to stated book? Is it cheap to, the average of the last 4 years' earnings? And then your left brain is hopefully saying, how does it stack up versus his peers, competitors? Has management done intelligent things when you look across that value line? Were they shrinking shares at discounts to book when the stock was down? You can read about acquisitions. Did they do those and make sense with them? We used to do every S&P tear sheet when they came in. You know, the tear sheets were great ways, but since S&P quit that, we don't do it any longer. We look at our 10 best investors, 13 Fs in the U.S. People like Peter Kundle, that I understand is coming in a couple of weeks. Peter's a very, very shrewd investor and a very cheap buyer of balance sheets. But anyway, we look at 13 Fs, and what we really like there is to find out what people are buying and have the stocks gone down since they bought them. That would be good. I mean, you know, if smart people have bought them at one price and they've gone further south, then it may warrant our attention. Another part of our search process is just prolific reading. We read every Forbes, Fortune, Business Week, Barron's, the Wall Street Journal, and we're not very efficient at it. I think we all want to do the same kind of reading because we're interested. We probably ought to divide that up and whatnot. We read trade journals of every industry that we think we're capable of understanding the companies within those industries. We reprice every week or so the 200 most attractive companies in the world. And by that we mean those companies and businesses that we can understand that have very good economics. And you know, it might be a Diageo, it might be a Comcast, it might be you know, a food company that has had a terrific long-term market position. We used to say that about Nabisco. We owned it twice, and it had 9 of the top 10 cookie and cracker brands. So anyway, you know, when we've identified the 200 or so best companies in the world, we've done appraisals, we know what we think they're worth, and then so we're constantly repricing them to see if something's less than our hurdle of 60% of appraisal. When we make management visits, and we go see almost every management company that we're involved with 3 or 4 times a year, and in those management visits, the first question we always ask is, who's your best competitor and why is it the case, and you know, what's the thing you worry the most about, and you know, competing with this individual company. And so we learn a lot about various companies that we might not know about from the best source of all, and that's the company on the street every day competing, sales force, R&D, what have you. So anyway, these are all various ways of trying to come up with a company that may warrant our savings dollars. The second part of this, you know, 3-part approach to successful investing, good search strategy. The second is being able to value a business. And at Southeastern, we value businesses 3 ways. The first is very traditional Ben Graham. I mean, it's go to the balance sheet, add up all the assets, take out the liabilities, divide by shares, based on today's economics, not on historical cost accounting. So, you know, cash is cash. Inventories are inventories plus some LIFO reserve minus the tax liability. Receivables are receivables times some collection factor. Anyway, you just go down the balance sheet. You could do it if you were in the 6th grade with a little help. You add up the assets. And you need to make good adjustments, you know, the intangibles on the balance sheet. Brand names, trademark, franchises may be incredibly valuable. General Foods was an example where, you know, Jell-O was on the books for a few dollars to register the rights. Well, it's the only product in its category. It's got a monopoly. It's just gelatin, sugar, and water. And they sell it for a lot. They got a big gross margin. We like it. You know, you need to look at all the assets and try to be very fair. What would you pay for them? And what you would pay for them would be kind of the discounted cash generation they're going to produce in the future, come brought back to the present. On the liability side, you got to be really careful there too. You want to look at what's on the balance sheet and what's in the notes. You want to know, you know, what the pension assumptions are. You want to know what kind of interest rate environment we're in, what you think they're going to be on average over the next few years. You want to know about the post-retirement medical. You want to know about all the things like the potential liabilities from litigation, etc. And so you total it all up, you divide by shares and see what it would be worth on the courthouse steps if you're going to liquidate the business and distribute the proceeds to every owner. if you can buy it at half of that, you got a riskless investment. And and it may be, as Buffett describes, a cigar butt. It may not grow, but if you can buy a dollar for 50 cents and you think they're going to give you the dollar reasonably soon, then that's not a bad thing to look at. Secondly, and this is where we spend about 90% of our time, is trying to figure out what the company would be alive, and that's the discounted cash generation. Anyway, we talked about it. You want to figure out what the cash generation of the company is today, and that is those things I mentioned. The net income, the depreciation, the depletion, the amortization, deferred taxes. That's what comes in the door. And then you've got to put required CapEx out to keep the roof on, to keep the parking lots paved, to keep the machinery running. So you take out the required CapEx, and you take out the working capital needs of the company, the amount of money that you have to put up each year to finance inventories and receivables. And so when you take required CapEx and working capital needs from gross cash flow, what's left is the coupon of the business, the free cash flow generation. It's what you can put in your pocket if you own the whole company. And so you figure that first. You take it out 8 years for a company like Diageo that we think we can understand. You take it at a very conservative growth rate. You put a terminal multiple on it based on, in our case, almost GDP-type growth from there. And then you come back at a discount rate that's conservative. And our discount rate's probably about 9% today, on the thesis that it would take 9% for us to be in business, to be out there with our capital at risk competing. So you do that math, and you come up with a conservative appraisal of a company that you think you can understand. Or lastly, and most often, applying our discounted free cash flow valuation methodology. A DFCF appraisal is only as good as the certainty of your model's future cash production inputs. It's our strong opinion this tool should be used only for understandable, competitively advantaged companies whose future cash production is reasonably predictable and assured. And then finally, we have a third method, which is our comparable sales database. Every company in the monopoly newspaper area that's traded, we've recorded the metrics. Price to revenues, price to operating cash flow, price to subscribers. So if we're valuing, say, Knight Ridder with 31 monopoly newspapers, we're going to value each of those papers based on what our discounted free cash generation gives us, and then we're going to go to our comparable database and figure out what other similar newspapers have traded for. And we adjust those comparable sales for the interest rates in which they occurred. If a newspaper like the Boston Globe sold to the New York Times when interest rates were 8%, that's going to be a lower set of metrics than if it sold today at a 4.5% or 5% interest rate environment. So balance sheet approach, ongoing discounted free cash flow based on the company being successful and going down the road, and we compare both to arm's length transactions of similar businesses, and we've got a 30-year database of businesses that have traded. And then finally, discipline, patience. We don't swing if it's not, if it's not discounted from our appraisal by a significant number. And we are very patient. We wait until those opportunities occur. Right now, as we were saying earlier, this is one of the most difficult periods that we've faced in 35 years, in that we're not getting a lot of volatility, we're not getting a lot of inefficiency out there. Fear and greed aren't being kicked around like they normally do. But you can be sure that that will recur, and we'll be given an opportunity to put some of our cash reserves to work. We've got about 25% on average. It's earning a 2% return, and that's not very attractive. And if you don't have that discipline that I'm talking about, if you aren't patient, as I said, we are very patient. 2% returns are not attractive, but they beat the hell out of down 50. Real money. And if your corpus is in place for the next psychological bubble burst, you're going to be there with liquidity. You want to be a liquidity provider in this economic system that we live. Never one that has to go find liquidity. Great investments are when you have resources and others don't, whether you go back to the Depression or whether you go over in various parts of the world and various dislocations that have occurred. And we could care less what the market pundits are saying. And if you don't have that discipline and patience to go with it, you'll always be sucked in to this vacuum of illogical behavior. Yes, sir. Quantitatively, as many of you know, we've always required our investments to have a significant margin of safety, or ones where we receive much more intrinsic value than the price we're asked to pay. Keeping in mind that intrinsic value represents all the future cash an investment will produce or could be liquidated for, and that book value reflects all of the company's past retained earnings. If you understood a business perfectly and the nature of the business, you would need very little in the way of margin of safety. So the more vulnerable the business is, assuming you still want to invest in it, the larger the margin of safety you'd need. If you're driving a truck across a bridge that holds 10,000 pounds and you've got a 9,800 pound load, if the bridge is 6 inches above the crevice it covers, you feel okay. But if it's across the Grand Canyon, you don't feel too good about going across that bridge. Warren Buffett. And he says it just perfectly. Now, if it's General Cinema and you're getting $26 of cash for 18, you know, you might ought to be able to pay almost 26 with no margin of safety in the cash, and you got the, you know, Neiman Marcus not a bad business. You know, somebody's getting ready to get a lot of money for that right now. We're a large shareholder. And also, you know, the movie theaters weren't all a bad business. So they were out there, tangible assets, very valuable, that you didn't even pay for. So that margin of safety, I wouldn't have needed a very big one there. Now, if it's, you know, some ethical drug company that's, you know, having its patents roll off and they've got to get an R&D, you know, team cranking to replace that drug, whoa, you got to have a great big margin of safety, especially with all the litigators telling people that your drugs kill people as opposed to cure them. So, you know, the answer is just as Buffett says. If you're not sure how far you can fall over in this, if this bridge breaks, you need a heck of a margin of safety. You want a really strong bridge, and you want to tiptoe across it as a featherweight if it's a risky business. But if it's a rock solid business, you need less of a protection.
Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.